In March of 2023, the unthinkable happened. USDC, which many experienced professionals believed was provably the safest stablecoin in the market, depegged from the US dollar. Skeptic pundits and commentators were once again quick to quip that stablecoins aren't stable. So, are they right? Could it be that all stablecoins, including USDC, are always going to be unsafe? Let's find out. This is one of the beefier videos I've put together, and happily so, since there are a lot of interesting interrelating issues that help to shed light on what happened here. I've created timestamps to help you navigate to the parts that you may find of particular interest, or to allow you to consume this video in chunks at a time if that's your preference. This week's video also builds on the previous one that I created explaining the core foundations and principles underlying major stablecoin designs. So I recommend that you watch that one first if you're not all over stablecoins already, or if you feel that you're not quite connecting with some of the details that we are going to cover today. In that last video, we took a look at the fiat-funded reserve model for stablecoin issuance and introduced the two leading stablecoins that have adopted this model, USDT and USDC. Both lead stablecoin adoption by a very wide margin compared to all others, as you can see in that chart there. USDT and its parent company Tether will also be in focus for today's video. As we were discussing those fiat reserve models, we saw that their objectives restrict the kinds of assets that they can hold. Our reserve needs to be reliably effective at fulfilling token for fiat redemptions and preserving good value and risk attributes while it does so. And furthermore, it needs to establish and maintain credibility of that value backing in open and free markets. So that restricts us to this less risky part of the spectrum. But even taking all these requirements into account, there is still a range of assets that could technically satisfy all these requirements. And those assets still have a risk ranking between them, even if those risk differentials only become material in times of severe stress. In 2021, Circle made a public commitment to only hold the very safest assets along this part of the risk spectrum, declaring that it would only hold cash and short-dated US securities, which are deemed to be the safest and most liquid non-cash assets on the planet. Of course, we all know that talk is cheap in crypto land, so Circle went out of its way to voluntarily offer monthly attestations of its balances provided by reputable firms like Grant Thornton and more recently Deloitte. And indeed, you can see that change recorded in their published attestations for July and then September of 2021, with all those riskier holdings going to zero. You can download these attestations for yourself on Circle's website in PDF format. Let's just update the view to their holdings of 2023 just before the depeg happened. And we can see that everything lines up with their communications at that time, with 20% of their reserves being held in pure cash and 80% being held in US Treasuries. Circle's approach stands in marked contrast to Tether, the company behind the top dog stablecoin USDT. Tether has always been controversial and has only offered its transparency begrudgingly when pushed to by other external events. Its posts and communications updates often sound like they were spoken by a stroppy teenager, to be frank. Tether only began making public disclosures after being forced to do so privately as part of a settlement for a case brought against them by the New York Attorney General in 2021, while Circle, on the other hand, has been offering their attestations since 2018 because it was part of their core philosophy. Now, in fairness to Tether, today you can also access and download their attestations from their website, just as you can with Circle's, although for some reason they're only published on a quarterly basis. So if we look at the quarter just in the period just before USDC's depeg, we see that they were holding a much more diverse portfolio. One of the main reporting headers we can see here is labeled cash and cash equivalents. And all these holdings in this category are indeed very safe. But if we look at their literal cash holdings here, they only comprise 0.6% of the entire total. Now, further down, We have a bunch of interesting items, including corporate bonds, precious metals, secured loans, and bitcoins. So here we are definitely straying from a safe asset allocation. And these sorts of assets comprise a full 15% of their holdings, which is pretty much where they are today as well. So all this definitely puts Tether further to the right of USDC on this riskier end of the safe end of our spectrum. And some people would not even be generous enough to count this as still being safe. But let's grant that that is up for debate. And if we set aside Tether's consistent demonstrated preference for a lack of transparency and accountability and just look at their asset holdings, those asset holdings are not necessarily a mark against USDT's standing as a stablecoin. As I am implying with my own exposition, Tether's portfolio holdings are still situated within a safer part of this wider risk spectrum, and their portfolio could be wholly adequate for their requirements. We have some evidence to support that from the world of conventional finance, with the example provided by money market funds. Now, if you're a crypto native and aren't familiar with money market funds, I'd say they offer you a very useful case study to help you to get a more sophisticated grip on the issues that face the stablecoin industry and to anticipate future possibilities for their regulation and evolution. But if you're from TradFi, don't lapse into lazy thinking and assume that stablecoins are just exactly the same thing as a money market fund, because they are definitely not. Let's see why. The key difference is that money market funds were designed to be an interest-bearing savings product. They offer savers a way of earning a better return on their cash than retail banks would offer on an ordinary deposit account, while still giving savers easy, liquid access to their funds at a very, very low level of risk that all but assures that their funds have not lost their original dollar value as were invested. Stablecoins are very different. In a sense, they were designed to be the very antithesis of an investment or risk product. They were created to be assets that would hold stable value in a blockchain universe that was otherwise awash with crazy amounts of risk. That service of stability alone was valuable enough so that stablecoins never had to pay holders a rate of return as part of their value proposition. But that means that any returns generated from the management of assets held in stablecoin reserves all go back to the stablecoin issuer. Anyway, let's restate this in slightly different terms. The primary economic function of money market funds is to provide a money-like investment, while the primary economic function of stablecoins is to offer a money-like transaction asset natively on blockchains. Finally, it is very important to note that money market fund shares are only directly tradable with the fund that issues them, and the shares aren't tradable between investors on secondary markets. For stablecoins, the opposite is true. They do trade between investors on public secondary markets, and that's the whole point. Stablecoins have to be designed so that they garner confidence from free individuals in free markets so that they are worth their face value. Otherwise, they cannot fulfill their primary purpose of being widely transactable, stable value assets. As I said in the last video, if nobody gives you $1 for your dollar, then it isn't worth $1. So those are the important differences between money market funds and stablecoins. And if this is all new to you, these differences may appear technical or subtle, but I assure you they are in fact very important and substantial. They are likely to have material ramifications for how stablecoins come to be operated and regulated, as we'll see later in this video. For now, let's continue looking at ways in which the comparison between money market funds and stablecoins is illuminating. If we look at money market funds, they come in a small number of types, and one of the most important distinctions lines up with the amount of risk being assumed by their investments. These two relevant classes are government money market funds and prime money market funds. These labels and formats became much more strictly and rigidly defined after regulations were brought in by the SEC following the 2008 Great Financial Crisis. Before those regulations, any money market fund was allowed to report that its net asset value, or NAV, stood at $1 a share. a declaration that asserts that every share you own is worth $1. This sends a signal to investors that supports the psychology of trading these shares at a value of $1 each. Notice how very, very similar that is to stablecoins already. The stress of the bank collapses in 2008 revealed that funds with riskier holdings deviated significantly from this $1 per share value. And the difficulty of telling apart which money market funds were exposed and which weren't, and what level of risk was in each of them, contributed to the contagion that was propagated by this event. The SEC therefore brought in rules saying that larger institutional prime money market funds with riskier holdings were no longer able to make statements of this kind, since they were shown to have been misleading in times of acute stress. Only funds with the safest holdings were allowed to report their net asset value at $1. So, did these new regulations kill off the riskiest money market funds? Not at all. Prime money market funds certainly went into decline, as you can see from this chart, which clearly divides the point in time at which new regulations came in, but they remain a hugely successful and significant part of the money market fund market, comprising 15% of the $5.6 trillion market today. And this demonstrates that they are clearly a viable and sustainable investment. And this brings us back to what I was just saying about USDT's reserves. Composition of Tether's reserves are definitely much riskier than those allowed for prime money market funds, but they may still be well up to the task of offering a robust assurance of $1-for-$1 redeemability for their tokens at short notice in the majority of market conditions. But don't forget, while a prime money market fund pays you a return for the extra risk, Tether is giving you absolutely nothing and is keeping all of the extra gains for themselves. So, we can now appreciate that USDC's reserve standards do align fairly closely with those being offered by the safest money market funds, government money market funds, that are allowed to report a net asset value of $1 per share. And I have no doubt that that similarity was deliberate. But looking again at the foundational differences in the purpose of money market funds and stablecoins, we note that USDC is not being designed to be an investment asset, but to be a transaction asset. It is aiming to be money on the blockchain, and that gives it a professed economic function that is much more similar to a bank than a money market fund. And it is that comparison to banks that Circle itself has been pushing for when explaining its product to regulators and lawmakers. When doing so, Circle has argued that USDC is not just a safer form of blockchain money than all other stablecoins around, but that it is also a safer form of money than the money that is created by ordinary banks. In order to explain these claims, let's first wind back to the Terra Luna crash of 2022. The algorithmic stablecoin, UST, managed to become the third largest stablecoin by market cap, and then suffered a devastating collapse that brought an end to several high-profile operators and likely played a role in the collapse of FTX as well. We can see from this chart coming up that there was a flight to digital safety, and USDC appeared to be benefiting at the expense of USDT, which is consistent with Circle's clear positioning of USDC as the safest, most transparent, and trustworthy digital asset in the market. At the same time, I suspect that Circle's executive recognized that there was a pressing need to explain to less informed lawmakers how USDC was nothing like UST, and also to capitalize on the moment to elevate USDC's stablecoin model and reserves as being the best in the market and perhaps the only model that regulators should give approval to in the near term. And so, in September of 2022, Circle published a paper titled Macroprudential Considerations for Tokenized Cash, which was authored by Circle's chief economist, Gordon Liao, who has an absolutely ridiculous CV, including Uniswap Labs, the CFTC, Fed, National Bureau of Economic Research, Harvard Business School. Not your average moon boy. Really recommend you reading this paper. It is full of great literature references too, if you're interested in exploring these issues in depth. And You'll also get to see how rigorously you need to make your case to get the world's leading authorities and regulators to take you seriously. Anyway, the thrust of the arguments in this paper come down to 3 points. USDC is being designed to be a new format for money. This money format is backed by a full reserve of high-quality assets. This reserve structure makes USDC safer than ordinary bank money, and that's demonstrated by USDC performing better than some of the biggest, most regulated banks in the world on stress tests that simulate runs on their reserves, what we ordinarily call a bank run. So these are bold claims. Let's dive into them in detail. We already said a fair bit about the first point. In the paper, Circle distances itself from being compared to a money market fund. It argues that what sets them apart is this core purpose of issuing money on the blockchain. It follows that the relevant institutions that USDC ought to be compared to are the institutions that create money in our off-chain economies, which are mostly banks. Let's take a quick recap of the role that banks play in the money supply, starting with the simplest traditional picture of a bank's business as a pure intermediary. Savers take their excess liquid cash, deposit them at the bank, and these funds are then used to fund or resource loans that the bank gives out to others who need that cash now, with an agreement that these borrowers repay that sum back with interest over some defined term of time. The bank ideally shares some of that interest with the depositor who earns an interest rate on their savings. Now, for the bank, this is just their business. But for the broader economy, when this lending is done well, that lending performs a capital allocation service, a service that helps route unproductive capital to productive ends. Now, I think it's worth noting that this depiction already confers a degree of agency and influence on banks over how the money supply works, since their lending actions effectively give money to people and businesses who do not have it by using money that is otherwise in surplus and unproductive. However, when we discuss the role of banks in the money supply, we are almost always referring to them creating money in a stronger sense because they do actually create it outright. How this happens is also tied to the mechanics of their lending business. So let's take a closer look at that. Now, this pure intermediary model of banking where there's a one-to-one relationship between savings and lendings is really rather old-fashioned, more of a relic from times in the past when the physical transfer of money was necessary for economic transactions to take place. In other words, in the past, giving out a loan used to mean that you had to give out physical cash to the borrower. Now, banks always had some flexibility over how they managed that. Most savers would only ever come in to ask for a fraction of their deposits, meaning that the money that was left in the deposits could be lent out for longer periods while still being able to honor these smaller withdrawal claims by depositors. That worked out as a positive for the economy because it allowed banks to perform maturity transformation with these funds, using liquid assets to fund longer-term loans that supported longer-term economic projects. But do notice that in these pre-digital times, the importance and role of physical money still places a constraint on how much money the bank is able to loan. Today, our monetary system has become increasingly digitized and dematerialized, and banks have become active mediators in all aspects of monetary activity, including payments. Giving out a loan no longer means handing out physical cash. It means creating a digital record of a new deposit for that borrower, probably at the same bank. And because so much payment activity is now bank-mediated and they're so large, settlements between payments probably can be settled within the same bank, meaning that the net withdrawal rates faced by any individual bank fall further than what they were historically. The outcome of all this is that deposit liabilities present less of a constraint on the amount of physical cash needed to be held in reserve, and so that increases the total amount of lending that banks can offer. As a result, the amount of physical cash and liquid assets held by the bank form only a fraction of the total value of depositors' claims on the bank. This is known somewhat famously or infamously by now as fractional reserve banking. There's definitely a lot I could say about fractional reserve banking in and of itself, but today I want to keep the focus on how it applies to the case being made by Circle in their paper. For that, the key detail we need to grasp is that this form of money supply and creation exposes money to maturity and credit risks. In ordinary language, from the depositor's perspective, their money may be tied up for long periods, and they may find themselves unable to access their funds when they need them. And meanwhile, credit risks may mean that they stand to lose money from losses arising from bad loans. It's true, these risks only affect money that is held in our banks and not the bills we keep stuffed under the mattress. But today, so much money is held and managed by banks that it is not an exaggeration to say that the entire money supply is exposed to these credit and maturity risks. Now, before you rush out to buy your guns, hoard some more gold or Bitcoin, these risks have not been left unchecked. They have been mitigated by insurance schemes, by regulations on bank activities and the composition of their balance sheets, and by oversight measures and processes that have been put in place. Altogether, these have done a significant job at lowering levels of risk in the system. So far, now, they may come to fail us one day, but arguably the fact that the fallout in March of 2023 was successfully contained shows that something is somewhat adequate, at least. But anyway, that's enough backstory on fractional reserve banking to understand the second big claim that Circle is advancing in its paper. Unlike the money created by banks, all the USDC outstanding always has a full reserve of high-quality liquid assets behind it. In the paper, Circle argues that this means that USDC is free from the credit and maturity risks that are inherent fundamentally in bank-issued money. Furthermore, this design offers the possibility of us evolving towards a money supply system that is less in need of arbitrary interventions and regulation, all of which serve to cause all kinds of problems, including creating higher costs, distorting banking activity, and creating anti-competitiveness in the industry. Now, this is a big claim. So to substantiate it, Circle devised a quantitative test to support it, which takes us to the third big point of their paper. The test was designed to be highly similar to tests that are applied to the largest banks in the world as part of oversight measures instituted since the great financial crisis of 2008 in an effort to monitor and manage risks in the banking system. The test checks that banks hold enough liquid assets to withstand a prolonged run event. And this is measured in a clear and simple way by counting the value of liquid assets in relation to a specified run rate, a total sum of withdrawal value over a 30-day period. This is reported as a ratio called the liquidity coverage ratio, or LCR. So Circle puts these principles at work to examine what LCR values it would score in the event of a run on its reserves. And the results are quite striking. Even after applying more conservative assumptions than the official test, Circle reports ratios of about 2x. This includes a scenario where Circle uses historical on-chain data to estimate how quickly such a run could occur digitally, with the speed of digital runs becoming a growing concern for normal banks as well. That 2x score compares with a score of about 1.18 being reported for 8 US global systemically important banks in a recent comparable period. And so Circle offers that as strongly suggestive evidence that it is safer than traditional bank money. And then this happened. Let's spell out what we're looking at here. That chart shows the prices that traders were paying to exchange 1 USDC in free digital asset exchange markets. And we see that people were not willing to pay $1 for 1 USDC, failing that key test of public trust. If USDC's reserves were so safe, I would just spend all this time explaining how safe they were. Why did this happen? Well, the event was triggered by the failure of Silicon Valley Bank, which fell to a bank run by its depositors after mishandling some of those classic perennial banking risks that we've just been discussing, albeit under the exceptional circumstances and conditions that occurred after the pandemic. So what's this got to do with USDC? Well, on the 12th of March, Circle's CEO announced that they had been holding 3.3 billion of USDC's cash reserves at SVB, about 37% of all its cash holdings at that time. Now, at this point, it's unclear whether SVB was going to be allowed to fail and what that would imply for the funds that depositors had kept at the bank, because SVB was not eligible for some of the special protections and processes that are offered larger, more stringently regulated banks that would have protected depositors. And so Circle suspended conversion of USDC for dollars until this situation was resolved. Evidently, markets decided that the risk to USDC was super material, and the peg was only regained once they were convinced that Circle would be able to recover those funds held at SVB and maintain liquid assets to those reserves without much disruption. Now, if you look at this story, you might be tempted to think that this is nothing more than crypto hubris getting its comeuppance once again. But this kind of broad dismissal will rob you of some very important insights that are worth learning from in this episode that can also help take us forward. If we look back at Circle's paper, we find that there is some unconscious sleight of hand at work in its arguments. I say unconscious because I give them credit as good actors. If they had anticipated this risk, I have no doubt that they would have moved to avoid it. The stress test that they devise in this paper checks how USDC would hold up in the event of a run on USDC's reserves, but not what would happen if there were a run on the reserves of a bank that USDC was reliant upon. So the Shakespearean twist here is that USDC became a victim of the very same banking risks that it is trying to overcome. And that, ladies and gentlemen, finally gives us all the pieces of the puzzle that we need to attack the opening question of this presentation. Is USDC safe? I feel obliged to cover my rear end at this point and stress that none of what follows should be taken as advice on how to manage your financial assets or resources. This analysis is offered for educational purposes only, so let's get to it. Let's begin with understanding that what happened with SVB had absolutely nothing to do with the quality of the assets being held in USDC's reserves. All the arguments that Circle put forward refer to the quality of the assets in themselves. That was not what was at fault in this event. The problem instead arose from the banking and custody arrangements that Circle had sought for those cash assets, which ended up in the care of a troubled bank. These issues naturally lead into larger questions about USDC's exposure to risks in the US banking system. So when we ask, is USDC safe? It's these second set of issues that the depeg calls into question and which I will be focusing on. Otherwise, as far as I can tell, the quality of assets held in USDC's reserves and the transparency practices around them are still as good as can be and industry leading by a good margin. So let's focus on this custodial failure, asking ourselves, why did Circle place so much reliance on SVB? Let's remind ourselves Circle was keeping $3.3 billion, about 8% of its reserves, and about 37% of the all-important cash holdings at SVB. These are the readiest assets to service token to fiat redemptions. The scale of these operations would not have been lost on them, as they were far and above the largest depositor at SVB. So perhaps the most serious charge we can make is to put responsibility for this right in Circle's lap and say that the choice to concentrate cash holdings at SVB reveals poor, inadequate risk management at Circle. And this is effectively the charge that was made by a highly unflattering article that was recently published in Forbes. If the allegation here is correct, it would be seriously damaging to Circle's core brand, and poor risk management culture could continue to be present, rendering USDC unsafe. So it's a charge that we have to take seriously. Let's take a look. Let's begin by pointing out that Circle weren't the only institution who didn't see the SVB collapse coming. Other high-profile tech titans were caught out too, including Sequoia, who were reported to be keeping about $1 billion at the bank. And some business news reporters also point out that information about early warning signs were out in the open and could have allowed the Fed to have been proactive and preemptive in its response. So if these senior, experienced professionals and institutions were caught off guard, that at least suggests that the risk management issues involved were non-trivial, to say the least. That, however, may still not be good enough to pass off as an excuse for keeping nearly 40% of your cash in one location. But if we look at Circle's situation more closely, it is credible to believe that they genuinely had fewer options to dodge this event. There weren't that many banks willing to do business with crypto firms in the US. And there were just 3 of significant scale: SVB, Silvergate, and Signature. SVB being about double the size of Signature, as you can see there, and all of them went down around the same time. Now, speaking personally, I avoid reaching for conspiracy theories as the first explanation for events. That's my brand. You have no shortage of other crypto content creators who can serve you conspiracy-leaning ideas if that's what you prefer. The boring non-conspiracy take is that all 3 of these banks happen to be narrowly exposed to a few risks that undid them all. They all saw a huge glut of new deposits being made in them during the pandemic from a narrow base of clients in tech. That was then followed by an unprecedented whipsaw turn in interest rates, and where Silvergate and Signature are concerned, they were also directly exposed to FTX's collapse as well. Now, if we take all of that into account, I don't think it is appropriate to be pointing the finger squarely at Circle when they had so few options, all of which would have failed them anyway. Okay, well, let's counter this counter and ask, why do your banking in such a limiting and crypto-hostile environment as the US, if this is how bad things were? Well, the problem is that being firmly and transparently rooted in the US is vital to Circle's core strategic objectives. Circle is vying to be first in line to capture the US market for stablecoin payments when it finally opens. Moving away from the US would essentially forsake that pole position that they've been painstakingly working to claim for all these years, giving it away to some other incumbent bank or fintech who casually jump in at the last minute once regulations finally clear up. Tether was not exposed to this situation because they have no such strategic ambitions. But to hail that choice to exit the US as some kind of masterstroke of strategic insight into the risks of the banking sector is stretching things a bit far. It's clear that Tether just wanted to be away from all the hassle that the US is kindly visiting on all of its crypto firms, although in Tether's case, that may be hassle that's well warranted. So back to Circle. Their core strategic aim requires them to bank in the US, and that genuinely has left them with fewer options to dodge this bullet. There's just one more point to add to all this. Perhaps it's a less obvious one, and that's that Circle has to rely on banks. It is building up to become a large-scale payment service provider, and its product and strategy mean that it has to be connected to the off-chain financial system. And unfortunately, current regulations deny it access to core financial infrastructure that it ultimately needs to be able to do this. That infrastructure is currently only being made available to traditional banks. This isn't a crypto-specific issue, by the way. It affects fintech titans like Venmo, PayPal, Wise, and others. What to do about it is actually an active topic of discussion among regulators and lawmakers. So, having reviewed the situation leading up to the depeg, I think you can guess where my stance is. I think it is too simplistic to blame what occurred on incompetence at Circle, and I wouldn't take it to indicate that there are chronic failings in their risk management culture or strategy. However, to complete our assessment of this issue, we can't be limiting ourselves to examining what Circle did before. We also need to look at what they have done since, now that these risks are all clearly known and out in the open. So what have they done since? Well, let's look at the factors that forced them into a bind in the first place. Circle's core strategic aim to have a firm US base has not changed. They still want to be first in line to capture the regulated stable payments market when the US finally comes online. It seems that there's no way around this. If you want to be first in line there, you are going to have to weather the storm you face along the way. Unfortunately, however, regulations have basically not budged in the time since, and that leaves Circle exposed to the same problems as before, having few banks to choose from and having to rely on them all the same. And a look at the data supports this inference that these constraints are still limiting what Circle can do. Let's begin by bringing back the attestation. Before SVB, we see a clear 80-20 split between treasuries and cash holdings that they had been highlighting in their communications. Their most recent attestations now show a 90-10 split. Perhaps some of this is due to them pivoting to take advantage of the higher interest environment, or perhaps them downsizing their cash because there's not enough places to keep it. I won't know. We also see that some of the assets reported in their treasuries holding are now held as repo agreements, short-term loans to banks that are backed by treasuries that would be considered acceptable in a government money market fund. Now, Circle have stated that they have diversified their cash custodial relationships. But if we look at the footnote for that item, we see that almost 80% of cash is being held at BNY Mellon. Now, I have to say that even understanding that BNY Mellon is not SVB, I was surprised when I saw this. At face value, it does not look good that Circle is leaving the majority of its holdings with one custodian yet again. But obviously, we can see here that they are not trying to hide the fact. They are reporting this figure explicitly and clearly, which suggests that they've looked at this risk squarely in the face and have decided that this really is the best move that they can make right now. Now, I can't say I know enough, or certainly not about their private situation, to know whether this is the best that they can do. But if it is the case that for whatever reasons a greater diversification is not viable in the current environment, then a concentrated holding at BNY is not a bad move. Even though it is only about 50% larger than SVB by consolidated assets, it has global systemically important bank status, which means that it is subject to the strictest regulations and oversights, including capital and liquidity controls, and it is protected by insurance that SVB was not subject to. Circle's CEO has stated that they are also working to diversify their cash holdings geographically. I imagine this is mainly driven by operational considerations, but it's clear from the way it's being messaged that they are aware of the risk management benefits this drive offers as well. I haven't seen hard confirmations of that just yet. In terms of other news and announcements, we've seen a strong chief risk officer appointment in July of 23, a professional with a 32-year-long career at Goldman Sachs. They've been teaming up with the Amazon of Latin America, Mercado Libre, offering USDC to the Chilean market. Visa is also expanding its stablecoin settlement, which also includes USDC. Circle has also applied for a major license in Singapore, and although it doesn't affect the USDC token specifically at this point, has begun exploring opportunities with the Uber of Southeast Asia grab. All of these announcements bode favorably, in my view, for Circle's push to continue being seen as a respectable business with a global presence and reach. And so with all this, we've looked at Circle's situation in the run-up to the depeg and stuff that's happened afterwards. So let's return to our main question. Is USDC safe? One of the first things you're taught about in risk management can actually come across as quite counterintuitive. Good risk management is not about eliminating all the risks you face. It's also about clearly identifying which risks you are going to accept and take on as a business. With all that we've been looking at, you can appreciate that Circle's core business strategy is forcing it to eat a number of risks that ultimately stem from US regulatory policy towards blockchain business and the ultra-cautious but backward-looking approach to integrating newly emerging fintech businesses into the core financial system. The safety of USDC is going to be tied to those risks. Tether, by contrast, has definitely done all it can to get the hell out of the US's orbit as much as possible, as quickly as possible, for a different set of motives. So to the extent that US regulatory risks end up biting down against stablecoin businesses like Circle, then USDC is more exposed than USDT. But for similar reasons, if regulations work out for USDC, that creates tremendous upside potential. It has the opportunity to be a first mover in the US market and to benefit from the de facto moat being created by these new regulations, which would create higher costs of entry for would-be competitors. In this scenario, it would end up being safer than USDT by being officially sanctioned and recognized, and then being allowed to expand into a much, much larger addressable market. To get a sense of how bad these regulatory risk exposures are, however, sadly, our only option is to read the tea leaves on ongoing developments in US policy and regulation. It looks to me as if there are some good signs, even if they are progressing at a glacial pace. At the end of July, a committee advanced a stablecoin bill with bipartisan support. This is a kind of first draft that then gets amended and hopefully voted through in the House and a US Senate. However, with the recent ousting of the US Speaker, the dramas with the US shutdown, events in Israel, not to mention the greater emergence of partisan posturing over blockchain issues, it is questionable when this bill will make it through, even if lawmakers individually appear to recognize that they are falling behind international peers on this issue. In a separate positive development, the Fed recently announced the creation of a new supervision process for banks dealing with customers engaged in blockchain and digital asset activity. This should help normalize the provision of banking services to businesses engaged in these sorts of activities in the not too distant future. However, when it comes to providing access to core financial infrastructure, material changes are unlikely to happen anytime soon. Papers and statements by key authorities, including the Bank of International Settlements, the IMF, Bank of England, and the Fed, all communicate concern and trepidation about the consequences of making fast, significant changes to the makeup of the financial system. And if there's anything that I've learned since I started taking a closer look at regulation, it is that major shifts are slow, usually taking the best part of a decade to unfold. Consider that some of the Basel III regulations developed in response to the great financial crisis of 2008 only came into effect on January of 2023. So I think that some of the changes will come due, allowing for this greater inclusion into core financial infrastructure, which, remember, is a matter concerning various fintechs, many times the size of Circle today, but it will be very, very, very slow to arrive and not create material changes to USDC in the medium term. So it is also worth noting that USDC is unlikely to face competition from a retail CDBC over the medium term. There have been clear statements from the Bank of England and the Fed that they will not be pushing for the development of a retail CDBC that's used by ordinary households, and they prefer to let the private sector innovate and operate these new payment instruments and technologies. So, to summarize, we saw that legislation is making slow but credible progress in the US. There is an explicit move by senior authorities to accommodate and normalize banking for acceptable crypto business. But deeper changes to financial infrastructure in one way or another are much further away. Meaningful advances in the first 2 points alone, however, could land within a year or two, and that would be very significant in shifting the business realities and risks for Circle and the safety of USDC in a favorable direction. And with that, we finally got to the end. I know we covered a range of sprawling topics today, but I hope you see how they all fit together. And I'm just curious, are any of you still watching? If so, please leave your favorite emoji in the comment section below, or better still, let me know what else you would enjoy me making content about. Thank you for staying all the way, and I hope to see you again soon.